talk about financing for non-warrantable condos, one of the loan programs that allows for some of this stuff to move forward is the VA loan. As long as it is on the VA loan list, the building or project is on the VA approved list, then what that means is that the buyer, the veteran or active duty military, can move forward on that project. A really great example of a non-warrantable condo that is on the VA approved list is Condo-Mania. Okay, so I was working with a real estate agent. He had a ton of listings in the Condo-Mania buildings, and because all of the buyers had been veterans, we didn't have any issues getting those loans closed. And those buildings have short-term rentals. They have all litigation against them. They have all different kinds of issues happening inside those projects. But because it was on the VA approved list, we had no issues closing with those VA buyers. And then all of a sudden, we had a conventional buyer come through. And that's when we found that we could not proceed with the traditional loan program, that it was now in the non-warrantable condo bucket, and we had to switch loan programs because we were not using the VA loan. It had to go through a full condo review. So the VA loan can solve for some of that stuff, but otherwise the rest of us got to go through the full condo review. Non-warrantable financing options can also be, now we're down to the two other options, which is the portfolio loan, whereas the specific lender funds and services the mortgage, as we just spoke about. Those loans are now non-saleable to Fannie Mae and Freddie Mac, and they will not show up on the approved agency list, right? And then requires a minimum of 20% down to 50% down. So this is going to greatly affect your buyer pool, right? Now we've got a buyer that maybe cannot come in with 5 or 10 or 15% down. They've got to come up with 20 or more percent down payment. And then when we are talking about non-qualified mortgages, qualified based on alternative methods, so we're talking about income here, okay? Qualified based on alternative methods, usually instead of traditional income verification. And then as Yobi had mentioned, DSCR, who knows what DSCR is? That's a buzzword right now.
It's a debt service credit ratio. Basically, you are going to take the total monthly obligation to the subject property, so your principal, interest, taxes, insurance, and your HOA, and you'll divide it by the proposed rent, which creates a percentage, and you use that percentage to qualify for the mortgage.
Absolutely, absolutely. Kind of likening it to, say, a commercial loan, okay? So when we are dealing with residential loans, for the most part, it is the individual, it's the buyer that is qualified for this mortgage. But when we are dealing with DSCR, or as Suzanne had mentioned, debt service coverage ratio, we are no longer looking at the qualifications of the buyer or the individual. We are looking at the building, or I'm sorry, the unit. We are looking at the rent, the net operating income from that particular unit in order to qualify that property. So that does alleviate the buyer themselves from being on the hook to turning in any kinds of tax returns or anything like that. What we really are looking for is what is the rent going to command, and how do we get that to qualify for the program. And then, of course, another component of non-qualified mortgages or non-traditional income verification would be the bank statement loans, meaning in lieu of tax returns, we are using bank statements in order to qualify. And then, of course, stated income is back, right? Stated income.